Anyway, guys, I've got you in my ear, so. Hi, I'm Stephen Carson coming at you from St. Louis, Missouri, in these United States. Um, Welcome, not just to the show this week, but to the beginning of a series. I think you're going to find this quite interesting. We don't always have to talk about history from a long time ago. This is history that I remember. But I think we're going to learn a lot more about it than most of us understood, at least when going through it. So, okay, couple of things to mention. First of all, we had last show was our end of year contest, and I hold in my hand a list. No, I hold in my hand, kind of hard to see on the camera. Anyway, silver coins. So those are going to be mailed out as soon as I get a minute to run out and do that. To our winners, thanks to everyone who participated and our guest judges who were very patient. Didn't manage that very well and ended up being like way longer than it should have been. But anyway, now we're prepared for next time to do a little vetting before we get to the final round and the final stream. But anyway, that was great fun. If you missed it, please check it out. You get to learn from these Mr. D and Pharaoh who have a lot to bring to the table, shall we say. Okay, also, please support the show through Subscribestar. That is, money has been used for the prizes, for buying a computer so I can broadcast this show to you, and for lights coming soon to fix my lighting problem. So I put it right into the show. And then producer keeps reminding me, like and share. That's how you can help. Like the video and get it out on your networks. Basically we're finding that we're pretty sticky as a show. People do like it and subscribe and watch it. We've got all these metrics, right, that Google gives you, so you can see all this stuff. So we're doing well in that regard. So literally we're just at the build audience part of developing the show. And you can help us build that audience. So anything you can do along those lines is greatly appreciated. All right. Let's bring on 1, 2, 3 guests. Okay, welcome Ryan from Oklahoma.
Hello, how are you doing?
Doing well. Ryan Turnipseed, I should say. And then we've got Mad Mercenary from Australia.
Hello there.
Hi. We've got Mad Merc with us for a little bit more, so that's exciting. And then we have Black Horse from Toronto, Canada.
Good evening.
Hey, and not to jump too much into the topic, because I wanted to say something else meta before we get into this, but you know how Americans don't really know what's going on in the rest of the world, including in Canada. I'm sure you're quite aware of that, sir. What was the impact of 2008 in Canada at a very, very high level? Like, it didn't affect you guys at all? You got it worse than we did?
So 2007, 2008 in Canada, from the point of view of a recession, was much milder here than it was in the United States, and
okay,
even much milder than it was in Europe. In actual fact, it was a tremendous boon to the Canadian financial system because our banks, more or less uniquely in the world, were largely unaffected by the loss of capital that occurred. So if you go and look at TD or BMO or RBC or CIBC, you'll find that immediately after '08, they went on a giant shopping spree. So like TD bought 50% of Ameritrade. They went and bought, CIBC bought 37 banks in the US over the next couple of years. BMO bought Harris Bank in Chicago. There's just no end to the list of acquisitions there, to the point where the 5 Canadian banks, each of them now own, large portions of their business in the United States, purely as a consequence of acquisition of real estate.
So if I go to my bank site and look very carefully, I might find a maple leaf somewhere. That's what you're telling me, right?
Yes, exactly. So when you log on, if you're one of the whatever it is, 30 million Ameritrade users or whatever it is that they have, all of the technology and capital that all drives that actually came from your friendly Toronto Dominion Bank.
Wow. All right. So, okay, yeah. So what effectively happened is they stayed in a good place while other banks were hurting, and that put them in a position to make some moves right
Yes.
after 2008, basically, right?
Yeah.
Ah, cool. Okay. Oh, in case you missed the thumbnail, please check it out on YouTube. We have a graphic designer as part of the team here, and he just does such great work. If you look at it, I'm looking at it now. Sorry, it's hard for me to flash it up on the screen, but looking at it now, I asked Black Horse for a graph that would actually, I didn't want to put some random graph, right? I wanted to use a graph that was actually from the 2007-2008 crash. And so this is US real estate, right, Black Horse?
Yeah, so that's an index. I think it's the Case-Shiller index of U.S. real estate prices during the period between 07 and I think December 08. I think is the period I pulled.
Right. And so you see it taking some hits above the words, and then I thought this was really nice. Our graphic designer had the plunge happen, and it sort of leads you across the words, tumbling down to Milton Friedman. I thought that was kind of visual poetry there. Anyway, wanted to call that out. Okay, well, let's get right to it then. Did you want to say anything before I bring the slides up, Black Horse, while they're more or less
Yeah,
looking
sure.
at it?
So we're gonna do
Okay.
a review of the financial crisis here in a 3-part series. So today we're gonna look at sort of Act 1 of the crisis, which is the actual the origins of the real estate sell-off, the lay of the landscape, this sort of thing. Next session, we're going to look at the mechanics of the sort of domino effect itself among the banks, and then in session 3, we're going to look at the response. And in some ways, I love that we're doing this after this week's cigar stream over on Academic Agents channel, where they talked about the totalization of the financial system, because what we're looking at here is the event that created all the mechanisms that are now being used for I mean, modern monetary policy would not have been possible without the interventions that occurred during this period, especially in the response.
Right. I mentioned it in the marketing, but basically by the end of this series, you will understand why we wanted to talk about this thing from the ancient days of 2008. It is absolutely still relevant to us, what came out of this, right? Oh, yeah. And just to set expectations, we kind of toyed with doing it differently, but I believe our current plan is we're going to stick with our structure. So we are going to do this in 3 parts, but it won't be, part 2 won't be next week. Next week will be econ minis like normal. So we'll break it up with the econ minis, basically current events, in between doing this historical series. So our usual rhythm on this show. All right. Well, let's go to the slides. And I realized I'm on the wrong slide. Okay. Give me just a sec here. Okay, starting at the beginning, Act 1, the prelude. I guess.
All right.
Do we need to say anything on this slide, or?
Yeah. So let's just talk about this from the point of view of elite theory here. So in the 08 crisis, we're looking at a transition between 2 groups of people and 2 ways of managing the financial system. So for those of you who are scholars of the Fed, scholars of US financial regulation, you'll note that there was a large circulation between sort of 1975 and 1985, where a lot of positions were captured by disciples of the man after whom this stream is named, Milton Friedman, the Chicago School people. And
Right.
by the time 2000 hits, virtually all positions in the U.S. regulatory apparatus related to finance are held by Chicago School people. And 2008 is this crisis at the end of a long string of their management. So, and then we have Bernanke's face there, because Bernanke is the representation of what will come after.
Right, the Fed.
Yes. The new Fed as opposed to the old Fed. So if we want to move on to our next slide here.
All right, interest rates in the business cycle.
Yeah, so this is our classic Austrian theory piece here. So Ryan, do you want to walk through this?
Yeah, I'll give a very basic overview as a kind of like as a student, so that we just ground it in something that's easy to comprehend. Um, Imagine you just have people, no government, no centralization or anything. They will save up and they will invest their savings into forms of production and various types of investments where you can for security purposes, or they will use it to consume certain products. The more savings that everyone has, the more money that they are willing to lend out. Because if you have just a little small amount of money and you lend it out and it doesn't get repaid to you, you just lost, proportionally a lot more than if you had a ton of money saved in a bank or at home or under a mattress. So this is how we get interest rates, because interest rates is kind of what you pay when you get a loan to ensure that the person lending out isn't just going to lose absolutely everything, and to make sure that it keeps up with inflation. It serves a few other purposes, but for this, that's the main function. Correct me if I'm wrong. So higher savings, the interest rate is going to be lower because there is less risk involved. Lower savings, a higher interest rate. That's just naturally going to happen, and it has the natural corrective effect of making sure that everyone will then save, because it's a higher interest rate. You're going to save more, and you're not going to be taking out loans and taking risks because you'll have more interest to pay back. So introduce the Federal Reserve and the government now that we've got how it should be working. The Federal Reserve will centralize the interest rates, whereas previously it would just naturally set organically. The Federal Reserve will look at various forms of data, how the economy is doing by its own metrics, some of which are arbitrary, some of which can be argued to have an actual significance, and they will determine the interest rate needs to be set at this to encourage this amount of growth. Very rarely do they actually reach the growth target, but usually what this means is they will lower the interest rate so that more people take loans when they otherwise wouldn't have under the normal market system. And this is going to cause malinvestment. It's going to cause people to take out loans and build things and produce things that weren't on the market if we assume that there was no Fed. That's your malinvestment, things that wouldn't have been on the market. These things, whenever things hit the fan, essentially, you can't just keep producing where it is inefficient. You're going to have a purge of some sort of recession. People are going to stop buying. You're going to encounter production issues. There's going to be a crash somewhere. Your malinvestment is going to get purged. People are going to take out less loans. There's going to be less growth by the Federal Reserve standards. This is where, if you are running a top-down system, you hike interest rates because that's what naturally happens. Very rarely, though, does this happen. Usually just lower the interest rates even farther to see how much you can inflate the bubble. Let me know if I missed anything there. That's kind of how the student understands it.
Let's now contextualize this in the period of time before and after 2008.
Okay.
So the chairman of the Fed in the 80s was Paul Volcker. And Paul Volcker is very famous for raising interest rates radically in order to deal with inflation. This comes back to the dual mandate of the Federal Reserve. They have a mandate for full employment, which is sort of they interpret as managing economic growth, and they have a mandate for controlling inflation. Paul Volcker introduced what he called rules-based interest rate policy.
Yeah.
And carefully managed M1 and M2 as well as interest rates in order to control inflation, which, the 80s weren't exactly a great decade for limiting inflation. So, you can judge for yourself how effective it was, but certainly rules-based interest rate policy had the advantage of being highly predictable. Then 1987, Alan Greenspan takes over and is, I think, certainly the longest tenured modern chair of the Federal Reserve. And
I do believe he is probably the second longest. I think there was one of the original founders who was a little bit of the Fed, who was a little bit longer, but yes, he was
Yeah,
one of the
McChesney
longest.
was the Fed chair during World War II, and he was there for a long time as well.
Yes.
Long time as well. I don't know, but certainly in the last 40, 50 years, Greenspan was in there for almost 20 years. And in the first half of his tenure, he was credited as a kind of sage figure because he deviated from rules-based economic policy or rules-based interest rate policy, and it did not blow up in his face. And then and so you see this pattern where interest rates are lower than they would have been based on rules-based interest rate setting for a very long period, which creates a series of malinvestment bubbles: the saving and loans crisis, then the tech bubble in 2001, and then finally the real estate bubble. And so you can see each of these bubbles really fit quite nicely into the Austrian theory of the business cycle, with lower than expected, with interest rates that go down really quickly in response to a market event, but go up quite slowly in order to prevent damaging market returns. And so you have this sort of step function where there's a big step down and then slow steps upward, and you have malinvestment during that period where interest rates are rising slowly, and then you get a crisis again. And you can fit the decline in house prices in 08 nicely into this framework. So if you want to flip to the next slide there, where we'll again be showing.
I just wanted to throw in comments on the business cycle that I always like to include.
Sure, yeah.
Black Horse. One is that I feel like you can get lost a little bit with sort of money feeling very abstract, money and prices feeling very, very abstract and everything. So try to hold on to this when you're thinking about what goes wrong and what the story that the Austrian business cycle theory tells about what goes wrong. There's a real pool of savings, right?
Mm-hmm.
When we save in the bank, it represents, deferred consumption, and right. It means to some degree, it literally means we're not using stuff up when we save, right?
Right.
And therefore, that stuff is available to do something else with. Stuff. It could be people's time. It could be material goods, but it's real stuff, right, in the world. And so what happens with this is that by fiddling central management of the interest rate, for example, central planning of the interest rate, right? It's socialism. It's a form of socialism, as we've emphasized on this show. Then you start getting two groups pulling from the real pool of savings. The signals are telling them, the consumers, go ahead, keep consuming, and to the entrepreneurs, you can use all this stuff and start, doing ambitious businesses and so forth. So that's where you get this sort of party atmosphere, and you've heard probably the analogies of a boom being like a party, like where the liquor never stops flowing, that kind of thing, right? That's because there's an illusion that there's just like this, trade-offs are gone and we can just all draw from the real pool of savings. What happens with the bust is that reality kicks in and we realize, that stuff that I thought was there to complete this this project or to do this business I was doing, it's actually not there.
The savings are gone.
Yeah, and I cannot continue this project, and that's where you see business failures and so forth, right? So
it has been artificially lowered to seem profitable when it really wasn't.
Right, exactly. The interest rate has been lowered, right?
Correct.
And so a key takeaway, I know I make elementary points sometimes, but a key takeaway is that from the Austrian point of view, the boom is the bad part and the bust is the good part. And what I mean by that is the boom is where the economy is getting all out of kilter, right? The longer they keep it going, the more everything is artificial things are being made that aren't sustainable. You know, and it even goes to, as Paul Cantor and others have talked about, it even impacts culture. It starts impacting culture and so forth, right? People start acting in a less conservative way because, hey, whatever you do, everything just keeps going up no matter what,
Right.
And so it has all kinds of
called
impact.
this irrational exuberance, right?
Irrational exuberance, right? I'm sorry, whose phrase is that?
I believe that's Greenspan's.
Greenspan's. Okay, yeah, irrational exuberance. So then in the bust, that's really the correction, right? That is where things were all out of kilter in the boom, and in the bust, if you allow it to happen, and of course governments are always trying to prevent the bust from really doing its good work. If you allow it to happen, then it lets everything get lined up again, where the use of the real pool of resources, real pool of savings is realistic again, and the businesses that are built in a bust often are more solid, sustainable, conservative in a sense, that is not built on hype. So in the boom period, you often see a lot of hype, right? I was old enough to be through the 90s with the .com boom, and there was just hype. Hey, that's .com, just invest in this, and you will just make so much money. Everybody's making money, right? And then go ahead, Medmer.
Well, sorry, finish your point. I'll jump in after.
No, I was just going to ask. I don't want to jump ahead, Black Horse. Are you going to get into a little bit of the bubbly hype aspect of 2000? Before this, right before all these events. Later?
Yeah. Well, so a couple of things that to address here. First, there's definitely. You can view 08 through the same lens as a series of other market crises that have occurred in the period between sort of 1970 and 2010, right? The .com bust is comparable in some ways. The savings and loan crisis that I alluded to, the resources bust that occurred in the early 80s. So we've recently lived through the second oil bust in kind of the modern period. If you look at the price of oil in the early 1980s, you see this situation where oil drilling becomes enormously unprofitable after the oil shock of the 1970s, causes a lot of malinvestment. So this kind of pattern is a pattern that is consistent over the lifetime of the economic policy driven by the Fed that goes on sort of in the post-1960 world. So there's a sense in which 2008 is nothing different, and then there's a sense in which 2008 is something totally different. And I think it's worth exploring both. Now, the other thing I wanted to hit was there's a comment in the chat here where somebody has decided to inform us that the Fed doesn't actually set all interest rates, but only the reference rates. This is a topic that we will explore again through this series because it's certainly true that prior to 2008, the Federal Reserve sets reference rates, and then the market sets prevailing interest rates on most bonds. This generally is not true in the period after the 08 crisis. So in the period after the 08 crisis, there are a series of interventions made, quantitative easing, Operation Twist, the repo facility, et cetera, where the Fed takes increasing control over larger and larger portions of the yield curve in order to adjust interest rates in order to produce the results that they perceive to be correct.
Right. So this is a bit of a spoiler, I guess, but basically you're saying that through this crisis, what I'm calling central planning by the Fed actually increases.
Yeah, radically expands.
Radically expands. Yeah. Okay, well, let's get to this next slide. I've got it up now.
It's interesting that happened.
Only way to go is up. Go ahead, Medmer.
Well, it's interesting. In some sense, it's not interesting. In some sense, it is interesting. it's not interesting because obviously Greenspan had a huge incentive to increase control to make it seem like he was doing something. It is interesting in the sense that I think this was a guy who, even on a surface level, was more of a uh, hands-off approach sort of person. So, for example, or more on our sort of side of the issue. So, for example, Alan Greenspan actually wrote a little introduction for several of Ayn Rand's books while he was in his position. He often talked about how we need to let the market do its thing, and then he goes about and does almost the opposite of what he says. So it's a there's a difference between what he was professing and what he actually did. His actions speak more about his character than his words.
Yeah, and I think like part of the reason we titled the screen the way we did is because this is what we're looking at is the revealed preferences of the Chicago School economists when put into positions of power. So if you look at the Chicago School, there's rhetoric that Austrians would applaud, and there's rhetoric that Austrians would see as quite negative. And I think the appropriate way to analyze it is through the lens of revealed preference. So what we're looking at here is a chart of all transaction house prices over a very long period. I think 1970 to today, and you can quite literally see the bubble shape here in the period, I guess, beginning at about, I don't know, what would you say, about 2004?
Yeah,
Yeah, that
something
sounds
like
right.
that is where it seems the trend seems to be not in line with the previous, well, couple decades, really, right?
Yeah, and then
But and
one
I
of the
don't
things,
understand what this is. Black Horse understands financial markets better than I do. All transactions house price. That means nothing to me. What's that?
okay, so what that means is every time a house is bought/sold, the print goes up, and then you take a straight average across the United States.
Okay,
So,
sorry, I thought house was being used in some fancy way. You're literally talking about houses. Okay, got it.
yeah.
So a
So
bubble
this
in
is like
houses
the
starts in around
simplest.
2004. Yeah.
Yeah. So you see, your classic malinvestment cycle here, where prices start to increase at a rate that is out of line with general inflation and long-term trends, and you see a straightforward correction to that malinvestment cycle. The sections here highlighted in gray are recessions, and you can see, the big gray highlight being the 2008 crisis that we're about to talk about.
Right. Okay, next slide.
Yeah.
All right.
So the previous slide looks at the way in which the '08 crisis is a classic Austrian business cycle crisis. Now we're going to talk about the ways in which the '08 crisis were not a classic Austrian business cycle event. And at the center of this piece is the asset-backed security business, the largest asset-backed security market by far being the mortgage-backed security business. But there are several versions of this. If we look over on the left-hand side of our diagram, we've got borrowers coming into this market. The four largest categories here are real estate, auto loans, credit card receivables, and real estate consumer loans, consumer credit.
Credit cards.
Credit cards versus like stuff you borrow money to buy now, pay later at the brick, and these are securitized as well.
Oh, okay. So yeah, I'm sorry. Credit card receivables versus consumer loans. Those sound very similar to me. What's the difference?
So a credit card, the originator for that is is Visa or somebody, whereas a consumer loan, you have a retailer GE was big into this, but you also see, you want to buy a stove, instead of buying the stove outright in cash, you buy now and pay later. and then they're packaging those securities and putting those on the market.
Right, and it seemed to me, and maybe I just don't have enough history going way back, because maybe companies have been doing this all along, but it seemed to me that there was more and more of that. Where
Yeah, it got very, very
I-
popular as interest rates
Yeah.
declined.
didn't they call it
So-
financialization of the economy or something like that? Like every company that makes a widget now also loans you money.
Yeah, so GE is very famous for this because the financing arm actually eclipsed the revenue of the appliance sales arm. So
That's terrifying.
before it all sort of fell apart, but
Right.
anyways, the originators here are one piece of this. So you've got a set of borrowers looking for loans against these sort of four categories of assets. Then you have a set of loan originators, and these loan originators are generally, you have everything from your regional banks to your credit card company to your auto dealership. Usually auto dealerships that originate loans have like a lending corp that goes across the brand for the country. So like in Canada, Honda Motor Canada has a lending corp that interfaces with all the dealerships, but is not the same thing as Honda, the company. And you have the same kind of setup for auto loans, for credit cards, often for consumer finance as well. And in some cases, it's integrated. In some cases, they're distinct legal entities. And so you have two elements to the originator. You have a sales team whose job it is to push as much money out the door as possible. And you have a packaging team whose job it is to convince, to assemble these loans together into securities. So that means to take, 40 or 50 million of loans, assemble them all together into a single legal instrument, then work with either sell them and then work with a primary dealer is probably the correct term, and sell those loans, hopefully, either to the primary dealer or into the public market, so that you remove the risk of default from the originating entity. So there's a couple of things to realize about this process. One of them is that because the originator is not the same person as the one bearing the risk of default, you have a misalignment of interests at work here. So in a sort of traditional banking world where the bank is both the person who evaluates your creditworthiness for the loan and the person that's actually on the hook if you default for the loan, they have an incentive to very rigorously examine your creditworthiness. But in a world where the loan has been securitized and sold to the market, the originator only has an incentive to make sure that the credit quality is sufficient to successfully resell the loan, not that the credit quality will be objectively high in any sense.
So
You're muted, Turnip.
Whoops. Sorry. I was going to say they've outsourced risk here, and then that's caused the incentives to misalign to where they aren't as worried about being repaid.
Yeah, that's correct.
Cool.
So Black Horse, I remember that there was, that there was some kind of disjunction here, that somehow, when all this complicated mechanism was done, you had stuff bundled up that looked like it was rated, or that was rated in a certain way that should never have been rated that way if somebody took a deep dive and really looked at the creditworthiness.
Yeah, and there you're touching on another element of this diagram, which is the legitimization mechanism, right?
Right.
So not only do you have this misalignment of incentives where the loan originators have an incentive to package loans of the lowest possible quality that will be picked up by the primary dealer, you also you have this intermediating mechanism of the rating agencies and the particularly in the case of real estate, the mortgage insurance programs to attempt to put a stamp on those loans to say. So let's take the case of mortgage origination, Fannie Mae, the rating agency, and the primary dealer. You have an originating, usually regional bank, that has a very strong incentive to get the money out the door because that's where they get paid. You have the Fannie Mae that has an explicit government mandate to try to insure loans, especially to low-income people, and we'll touch on that, who has an incentive to try to jump on board as long as it meets the technical qualifications that they've laid out, and isn't looking too closely at the contents of the package. So they're offering insurance on either the individual mortgages or more commonly on the mortgage-backed security. You've got the rating agencies who are looking at Fannie Mae's creditworthiness rather than the creditworthiness of the actual loans underneath, and who are not accountable in any sense if the loans actually default, because the rating agency can't be sued for misrating a bond. And then you've got the primary dealer on the other side that believes in general that they can use that mortgage-backed security to resell to a client. And because of the stamp from Fannie Mae, is uniquely able to use the security in the rehypothecation market, which is an element of the crisis that is not generally appreciated. Which brings us
So
that
when
kind
you-
of part, that part that we don't usually appreciate, because I think it's new to me. Say it again.
Yeah, so because the mortgage-backed security has a guarantee from Fannie Mae or or one of the, there's about 6 asset-backed security agencies that existed at the time who were in this business of reinsuring mortgage and asset-backed securities. Those securities have a privileged or had a privileged position, both from a regulatory point of view and from the point of view of generally accepted practices in the rehypothecation market. So we now need to explore what happens to a mortgage-backed security once it has been assembled, because most people think that when a mortgage-backed security or a debt security goes to market, it's instantly or even generally distributed to the public at large, who stand to lose money should there be failure to repay. But that's not in fact the case at all. The bond market, unlike the equity market, is a market that the public generally doesn't participate directly in. What happens is when a bond offering or a mortgage-backed security offering occurs, one or more primary dealers will purchase the bond offering wholesale to begin with. Often they'll have a syndicate of investors that they've committed some portion of it to. So if Radlib Regional Bank was issuing a mortgage-backed security and I was a primary dealer, I would take all 50 million of that mortgage-backed security, and I would have a pre-arrangement with maybe $20 million worth of syndicated investors who would take the first 20 million off my hands, and then I would have 30 million of that mortgage-backed security sitting in my inventory for later resale. And then when a regular retail client comes to their brokerage application and wants to buy a bond, their investment advisor or their investment application that does the advice will look through all the things in inventory and seek to resell the mortgage-backed securities from the last 50 offerings that me as the primary dealer has participated in. But until they're resold, they're going to sit as an inventory on my balance sheet. Now,
Okay, go ahead. I have a high-level question, so finish on the detailer.
Now, as a primary dealer, I suddenly have all the default risk for all of the inventory that I haven't resold yet. So I have a bunch of different things that I might do to try to manage that default risk. One of them is I may go and purchase a credit default swap to try to pass that risk on to somebody else, which is something that a lot of these institutions did. The other thing that I might do is I might use short positions in various other securities to try to, so like a common tactic at the time would be long mortgage-backed securities, short government debt, because at the end of the day, you've got Fannie Mae, which is a quasi-government entity, guaranteeing the mortgage-backed security. So the thinking was that you couldn't have independent default between the US government and Fannie Mae. So that's element one. Now, element two is that because this is a stamp of, this has a guarantee from a government, from a pseudo-government entity, when I'm looking to use these mortgage-backed securities in the rehypothecation market, they're viewed very favorably from a credit quality point of view. The rehypothecation market is a stand-in for a bunch of different markets, probably the most significant of which is the repo market, for shifting cash between bank and broker-dealer entities in order to meet the liquidity obligations that the bank or broker-dealer needs in order to conduct ordinary business.
Okay, so a high-level question. I'm assuming okay. One of the ways that, in the popular press, as people started to try to understand what was going on, I would see focus on particular elements, right? Like you mentioned the incentive to give loans to low-income people.
Yep.
But as you describe this, and just looking at this diagram, which is probably simplified to some degree, right? Looking at this diagram and thinking as you walk through these, this is sounding a little more like what I hear about complex systems, like when nuclear power plants have a failure and stuff like that. And what they say is it's usually not one thing. It's that a couple different things went wrong and in combination resulted in a disaster. And so I'm wondering if you would you put your finger on one of these elements and say, well, that was really the thing? Or is it more like, no, it's the combination of incentivizing people to give loans to people who maybe couldn't pay them back, and that the people who assessed the loans didn't have the right incentives because they were just going to sell them off. And, do you follow me?
Yeah, so I would identify I would identify issues at 4 different levels here. Issues
Okay.
at the level of the lenders themselves, issues at this kind of legitimization mechanism at both the rating agency and these sort of mortgage insurance programs, and then issues in the mechanisms, issues in the rehypothecation market that binds all the financial system together. So you have 4 different elements there, all of which had really serious problems during this crisis. And that kind of failure is what took the 2008 crisis from a typical malinvestment bubble that fails without long-lasting consequences to a transformative event for the financial system.
Right. In particular, it should be clear, because we have some young people listening, this wasn't just that, hey, a few bad loans got into these bundles of mortgage-backed securities or whatever. There was a systematic problem, right?
Right. It's sounding to me if the government is pushing like terrible loans, it's going to be very common rather than an exception.
Yeah. So we'll talk about some of the scale here as we go through. So we're going to assess different parts of this at different times. Today, we're really going to look at, so the first piece that we're going to look at is the key element of this legitimization mechanism, the government mortgage-backed security insurance programs. That the largest piece of this is Fannie Mae. So if we go to our next slide here.
Okay, I'm on the charter now.
Yes. So Fannie Mae. So Fannie Mae is a very interesting entity. It was founded as one of these agencies during the reign of FDR in the 30s.
Surprise, right?
was privatized out in over through a series of steps between 1950 and 1970. But it was privatized out into a very unusual situation where it had private shareholders but operated on the basis of a government charter. And that government charter didn't just prescribe the areas in which it should do business, but actually the standards according to which it should do business. So you have Fannie Mae here taking direction from at least 3 different federal agencies as to how to conduct its business, rather than conducting its business according to the principles of maximizing return to its shareholders. So, and you can see explicitly in.
So forgetting its origins for a moment, Fannie Mae at the key point, I mean, maybe things changed since then, but at the key point that we're interested in, like early 2000s, say, what would it be analogous to? A heavily regulated utility company, or?
Yeah, so you might imagine that if you were, what's that Pacific electric company that's been sued virtually out of existence in California.
Mm-hmm.
So you've got a situation where you have private shareholders who are collecting dividends for the profits of the company, but have no effective control over how the company actually operates.
Oh, okay. So
they essentially own non-voting shares.
Your analogy is not too bad at all.
Okay, go ahead.
So essentially they own non-voting shares of the company.
Yeah, that's. I mean, formally they're voting, but they can only vote on certain things.
Right.
Mm-hmm.
So they've
no
got a
real
board
control.
They can decide who sits on the board and administers the charter that they're getting that comes down from federal agencies.
Right. But they can't make the big decisions. Basically, the board
That's
can't
right.
really. The board's hands are significantly tied.
I've pulled out from the charter of Fannie Mae is like one of these 400-page documents, or the charter circa 2007 was one of these 400-page documents that you see on all these agency websites. But I pulled out some key segments of it. So like one key element of its charter is that it's supposed to, quote, provide ongoing assistance to the secondary market for residential mortgages. That's the mortgage-backed security market, including activities relating to mortgages on housing for low and moderate income families involving a reasonable economic return that may be less than the return earned on other activities. So that means explicitly they're there to do malinvestment. By increasing liquidity for mortgage investments and improving distributions of investment capital assets for residential mortgages and financing. And you can see, I've also pulled out the part where they indicate that their activities are subject to oversight from, a bunch of different federal agencies.
Yeah, and just to bring the human element in here, Black Horse, a common misunderstanding for those who haven't thought through this is that you're just doing a favor when you get a minority into a higher level of university, or get someone poor into a loan that they wouldn't otherwise have been approved for. But that's not thinking it through. What happens in the long term, right? Because what happens later is the student ends up in a university that they are not really qualified for, and they end up dropping out. That's real. That really happens. That's a pattern. Or in what we're talking about here, someone gets into a loan that they really shouldn't have gotten into, and they should have done something more modest that they could really handle. And this whole system ends up putting people into positions that are really untenable. So it looks like kindness from a certain point of view, but it really isn't. It's setting people up for failure. Is what I said fair, Black Horse?
And not only that, if you scroll back to slide 3, that malinvestment has an effect on the broad market that puts these people into a more difficult position. So if you push more money into the housing market broadly, including to low-income people, low-income housing is priced based on the ability to pay from low-income people, not based on some objective standard of what that house is worth. Mm-hmm. So because pricing is contextual, if you increase the ability of the subject to pay, you increase the cost of the asset they're purchasing. So you end up having the same people buying the same houses for more money with larger loans, in a very similar way to the way that all the supports for student loans have resulted in higher and higher tuition.
Right. So in the housing market, you literally have someone who, their grandpa bought a home in this neighborhood, and maybe the neighborhood hasn't changed much, let's imagine, and the grandchild is priced out of it. Because
or
of the inflated prices, right?
Or they would have been priced out of it, except friendly Fannie
Yeah.
Mae is now ready to support them in a larger mortgage, and so they're now going to take on a relatively less responsible piece of debt in order to buy the same property, and put themselves in a situation where they're both locked into their job and very sort of financially vulnerable.
So I did jump to slide 3 for a moment, but we're back to the charter. Anything else you want to call out there?
Not unless anybody else has thoughts here.
Well, I'd like to ask a question. There were these institutions, Freddie Mac, that obviously were incentivizing and allowing for more loans that probably shouldn't have been given out. Were there other mechanisms that also allowed for this, for perhaps legislative changes on the state and federal level that perhaps
So we're going
allowed
to touch
for?
on that on the next slide.
Okay,
Fantastic.
so let me go to that. So
if we
Community
flip over,
Reinvestment Act.
we have the Community Reinvestment Act, aptly named. So you remember how we said that Fannie Mae is a creature of a bunch of these federal agencies. Well, the Community Reinvestment Act of, what's the date on that?
It would have been the 70s. I forget the date though.
Yeah, sometime in the 70s. Anyway,
Carter was president. Was president from 76 to 80. So
yeah,
77.
It's in the show notes
there you
here
go.
somewhere. Anyways, the Community Reinvestment Act is essentially a set of instructions to Fannie Mae and its comparable entities to make sure that the loans that they're supporting on the secondary market target particularly low-income urban communities. So you have targeted malinvestment as well as sort of general malinvestment. If one is assessing the probability of repayment on a loan, that assessment probably shouldn't take into account the lender's race. And yet anyone who's borrowed in the United States knows that that's part of what you fill out on a mortgage application. And here's why: the Community Reinvestment Act of 1977. Because Fannie Mae will buy the mortgage-backed security more readily if it has enough loans to people of, whatever targeted demographic.
Right, and this didn't go away as a result.
Like affirmative action, in the sense that it targets certain communities, giving them a leg up to get into these Ivy League schools, and then they can't handle it and they drop out.
Well, this is a bit different than that because those schools ended up slackening standards, and it's a bit hard to do that when you're dealing with money.
Yes,
right. Good point.
And Radlib, to your comment, this is still on the books. Fannie Mae still exists, though Fannie Mae goes through some really transformative changes during this period.
Okay. Well, I meant the Community Reinvestment Act, that mortgages would still be, to put it politely, mortgages are not race blind in the United States.
No, mortgages are not race blind in the United States at all.
Okay, next slide. Irresponsible. Oh, there we go. Irresponsible lending.
Yes. So we looked at house prices specifically, but corresponding to this bubble, there's this very interesting practice. A subprime loan is a loan, as defined in this chart anyway, is a loan to a candidate that without foreknowledge from the originator that you'd be able to get the package of loans guaranteed by Fannie Mae or a similar agency you otherwise wouldn't be able to make. So this is a loan that cannot be sold without a guarantee on the secondary market. And so you see a very significant spike in the percentage of loans originated in the period between 04 and 06 that don't meet these standards. And typically they're not meeting the standards during this period because of the practice of 5% or less down payments on real estate property.
Okay, so the
So,
subprime means what you just said. I've never understood what the term meant. Subprime means these are not ideal loans to be holding if you're a bank.
It
Right.
means that the bank without a guarantee it means that you can't successfully make the loan without intervention along the period.
Okay, got it. Okay, so the red line, let me walk people through the chart. Actually, I don't know which is which. What is the red
So
line?
the red
Is that
line is home ownership
rate?
rates.
Okay, got it. And then the bar graphs are the subprime share of mortgage origination. Okay, so the bar graph here, this is no secret. I mean, it's not like they only figured this out after the crash. Anyone who cared to look could see that, what, we're talking a doubling more? It's something like
Yeah.
a doubling from the late 90s, early 2000s, going into 2004, 2005, 2006. Something like a doubling of the subprime mortgages, right?
And what you're looking at here is not a gradual trend over time. What you're looking
Right.
at is a response to different standards given out to organizations like Fannie Mae and Freddie Mac through DHS, etc., for how to go about lending that are expressly intended to increase homeownership rates, which is a key part of the sort of Bush compassionate conservatism agenda.
Right. So this is AA's downstream from law thing that we're looking at. This is not spontaneous order. This is a policy change resulting in a lot more subprime mortgages going on, right?
So in the period between sort of 1990 and 2008, home ownership is viewed by policymakers as this kind of gold standard of financial success for the middle class. Bush Jr. Makes a key part of his economic plan, bringing home ownership to otherwise disadvantaged communities. He uses the levers of power at DHS, etc., to try to make that happen. You can see there's actually quite a bit of success in trying to make that happen, and we'll review some of the results.
It's worth pointing out as well, this was a policy that Bush directly stole from his predecessor, Bill Clinton. They had almost the exact same policy where they would go to press conferences and whatnot, take out a graph of home ownership over time, and they would basically just say, we're going to enact these laws, this legislation, we're going to throw this money at this group to make sure they can own the house, because that's the American dream. And then, so it wasn't just Bush. This has been going on for quite a while. Bush, however,
Yeah, but pushing the lever in 2003, 2004 had a significant effect.
Yes, Bush has both parties supporting him, whereas Clinton had stark opposition from one. So
one, before we leave this chart, Black Horse, there's one thing that confuses me. So as you say, its line go up from 1997 to 2004 on home ownership rate. And then you said that there's a policy change, which we're seeing in the bar chart, where a whole bunch more subprime mortgages. And then I noticed that the home ownership rate doesn't just stall out, but starts dropping at that point. Now, this is a couple years before the crash.
Yeah, so if you hold this chart up in one hand and hold our chart of prices up in the other hand, you'll see that actually a lot of these, what happens is prices start to really accelerate in the period sort of 03, 04, 05. And so the proportion of potential home buyers who can't meet conventional mortgage standards starts to increase as a consequence of increasing prices. And so you push the lever on increasing the volume of subprime guarantees you're going to make in order to try to prevent the logical consequence of that increase in home prices being that low-income borrowers get increasingly locked out of the market. It seems that they didn't push hard enough in order for homeownership rates to actually go up. They just pushed hard enough to prevent them going down as quickly as they might otherwise have.
Okay. So massive policy change literally results in treading water on the homeownership rate. Whereas if the market had had its way, we probably would have seen that red line really drop as opposed to kind of hold steady, right?
One would assume, right? You would have either seen that homeownership rate really drop, or you would have seen a slowdown in the acceleration of prices, right? You would have seen one side or the other win the supply and demand argument there.
Okay, I'm going to start gently prodding us along because I noticed that we're on slide 7 out of 22.
Some of those are going to be rapid fire, keep in mind.
Yeah.
Okay, good. Okay, next one. Mortgage-backed securities, a mystery stew.
Yes.
Very good.
So we've talked about this already. So we have this situation where originators are assembling mortgage-backed securities out of loans and then having them stamped with ratings from the rating agencies and guarantees from Fannie Mae, Freddie Mac, etc. And the primary dealer, their counterparties in the rehypothecation market, and the individual investors have almost no transparency back to the original mortgages. So, like when I was working on a trading desk during this period, if you tried to get data on a mortgage-backed security to the actual mortgages that were part of it, first of all, that data would almost universally be at least a quarter old. Second, that data, it would be extremely uncommon for like a rank and file person on a bond trading desk to have that data, much less an individual investor.
Okay.
So even if you wanted to do your due diligence, it would have been extremely difficult to do so.
Okay, so there's some transparency problems going on.
Yes. So just like when you order the mystery stew at a low-class restaurant, there's some transparency problems. The mortgage-backed security during this period has some transparency problems. And the consequence of those transparency problems is a lack of differentiation in pricing between mortgage-backed securities made up of quality, mortgages of high credit quality and mortgages of low credit quality.
Okay, moving on, right?
Now let's talk about the scale.
And as you mentioned before, the rating agencies were only really looking at Fannie Mae and Freddie Mac, and
that's right.
their ability to back these loans, and not the actual loans themselves and the quality.
By the way, this is a pattern I've noticed all my life, and I've wondered about it, which is that for some reason, because I guess people aren't anarchists, I don't know what their problem is. They look at the government putting a seal of approval on things and they like take it seriously, right? So, hey, the FDA approved it, so I'm going to pop this pill, like you would think that we'd have enough experience that the state is not like a good guarantor of quality that you would like factor that out. Like rational people would factor it out that the government put a stamp of approval and I'd be like, yeah, whatever, I'm going to check it out myself. But Black Horse, I mean, I think it's fair to say people take this stuff seriously, even in the financial markets. They should know better, but they don't.
Yes and no. So there is an issue of perception that you're looking at, but there's also an issue of regulatory demand, right? So we touched on this when we talked about the primary dealers and the rehypothecation market, but both the capital associated with the inventory that you hold and the rules around the capital for repos and other kinds of loan arrangements between banks and broker dealers, these are all heavily regulated activities, and the government recognizes its own, right? So during the period in question, you could get the same. The SEC Act of 1934, 15C3(1) and 1A would recognize, for capital purposes, a mortgage-backed security with a Fannie Mae guarantee as identical to a direct obligation, full faith and credit in the United States. Equally, when you were capitalizing your repo arrangements, if the collateral in the repurchase agreement was a Fannie Mae mortgage-backed security, you would be able to execute that repurchase arrangement without having to post extra capital. So
Okay. So here's how I'm doing my executive summary of what you just said. The government's like on both sides of it. On the one side, it's doing the rating through this quasi-private, but really controlled by government thing, right? On one side, it's doing the rating. On the other side, it's saying what that rating means is that this can be used in such and such ways in the financial market, right?
That's right. This is two agencies recognizing each other basically across the regulatory soup.
What could possibly go wrong? Okay, let's go to the next slide. Colossal commitments.
So you're telling me that government rated government and government found that government rating was good?
Well,
yeah, exactly.
No different than our friendly pharmaceutical evaluation agencies are telling you that certain treatments are excellent, and then other elements of government are saying that you must take them.
Yeah,
and
because
obviously
they're approved, right?
They're approved.
Okay, so we've got the colossal commitments up here, and we
so
are
this is
in
a
little hard to read.
From the financial statements of Fannie
So
Mae.
this is in millions. So when you see 7 digits, add another 6 digits on that. Am I getting that right?
That's correct. That's correct.
So these are 1 point. When we see 1 comma 996 comma 941, that's actually a 1.9 trillion.
That's correct.
Yes.
Yeah. Got it. Okay, go ahead. Explain.
So this is pulled from the financial statements of year end for 2006. So
yeah, the
December
first column is
2006.
First column is 2006. Second column is 2005.
And these are the guaranteed obligations for mortgage-backed securities for Fannie Mae. So Fannie Mae is guaranteeing $2 trillion in MBSs directly, and then there's some other there's another 1.8 trillion of other third-party guarantees that they have. So, and they're doing this on the basis of a proprietary risk model that says that they have enough capital to meet these guarantees based on their estimates of default rates.
Now, this is one of the things that's hard for me in the financial markets, Black Horse, to, the numbers get so big and so out of scale with what I deal with in my personal life, right? That I'm like, is 100 billion a lot? Is a billion a lot? Is a trillion a lot? I think what you're trying to communicate here is that several $1 trillion of possibly dodgy guarantees here are enough to cause real problems in the economy, right?
Yeah, so they had, so what I'm trying to communicate here is that you're looking at an insurance agency that has a vast commitment. Mm-hmm. So Fannie Mae in this context is acting as an insurer of these mortgage-backed securities, and they've got $4 trillion in commitments to insure. So and they're predicating this on their own estimates of what the default rate in that pool might be, on the basis of an uncorrelated real estate market across the United States. So they're figuring that if houses go up in price in New York, maybe they'll go down in price in Los Angeles or whatever. So that lack of correlation is a key element of their internal risk model, though their internal risk model for their determination of sufficient capital to ensure this pool was never disclosed publicly.
Okay, ready for the next slide?
Yeah, sure.
Okay, credit default swaps and the repo market. CDSs, we call them.
Yeah, so we mentioned previously that one of the ways that firms seek to obviate the risk of holding these securities in inventory or in repo was to purchase credit default swaps from a small list of firms that would write commitments for these things. A credit default swap is an agreement to pay you the shortfall in the event of a default on debt. So if I wrote a credit default swap on Radlib's mortgage and he failed to pay, and when he sold the property, it wasn't worth as much as the value of the mortgage. Me, as the credit default swap issuer, would have to pay the bank the shortfall, whatever that was.
Yeah, now this is a term, we have a term for this, right, which I think got well known after this 2007, 2008 business. That's called being underwater, right, for the property owner?
Yes, so that's
If the-
underwater
if
on
the
a
amount-
mortgage.
If the amount of the loan is greater than the value of the property, you're underwater.
Yes.
Am I saying that right?
That's correct. And
Right,
that
so credit
underwater
default
term applies
swaps,
to all
credit
loans
default
and collateral.
swaps, credit default swaps are a hedge for the lender against people being underwater. Am I getting that right?
So, yeah, in a manner of speaking. So they're a hedge. So the lender then pulls this up to a mortgage-backed security. If the aggregate of the mortgage-backed security is underwater, then the CDS writer is on the hook potentially for that shortfall.
Oh, okay, I see. It's not at the individual mortgage level. Same idea, just move it up to the bundling, right?
That's right. So,
Okay.
and it's significant that it's moved up to the bundling because the CDS writer is actually not a typical insurer, they're a reinsurer. So at the level of the mortgage-backed security, first you often have the guarantee of Fannie Mae or a similar agency. So they're the first one you go to for money when these people don't pay. And then if Fannie Mae doesn't pay, then you go to your CDS broker and say, where's my money?
Got it. Okay, now tell me if I've got this wrong. I don't know how deep you go on history of the mortgage market and stuff, but my sense is that being underwater, I'm sure it happens sort of in a healthy economy that isn't in a boom, right? I'm sure it happens in certain cases, right? But I would think that this is not something that you would run into a lot generally in sort
Actually,
of a normal
we
economy.
helpfully have a default rates chart on the next slide.
Sorry, wrong button. Okay, next slide. Okay, so recessions and defaults. So mortgage delinquency rate. Okay, now this is slightly different than what I'm asking, right? Because this is talking about delinquency. I'm talking about being underwater. Mortgage delinquency
Okay,
just
yeah,
means,
that's true. Underwater
Right,
and,
right.
and default rate is not necessarily the same thing. That's true.
right. So I'm asking about this underwater thing, and specifically, my sort of gut instinct guess is that you don't see a lot of loans underwater in a healthy economy. That's kind of
No.
weird, right?
No, so there are three factors that kind of come together here to create the large number of underwater loans in the period. The first is we talked before about the surge in origination of subprime mortgages, many of which had small down payments, small less than 5%, which meant that from a collateral repossession point of view, you had very little cushion there when
Right.
trying to liquidate those loans. So
Yeah.
in a default scenario, you repossess the asset, sell it on the open market. The amount of equity that's in the asset is your cushion against the price moving against you and the cost of liquidation.
Right.
So because of the origination of a large number of high ratio mortgages, you see a lot more of that. You also see a lot more of that because the aggregate downfall in price of houses during this time is much more than is common even in poor real estate markets. So particularly at the regional level in the Southwest, you had vast inventories of houses that the firms that are in the business of reselling foreclosed homes just weren't able to move. It wasn't even a matter of price; they just weren't able to move them.
Mm-hmm.
So you have as a consequence, you have what is previously an almost unheard of situation to lose money on a repossession become a commonplace situation.
Okay,
So
well you just said what I was guessing, which is, yeah, losing money on a repossession normally would be quite weird. I'm sure it wouldn't be unheard of. I'm sure it would happen, right? People trash a place and reduce the value of it, for example. Yeah, but it's quite rare. Yeah, but in this crisis, we actually saw quite a bit of it. Is what you're saying? Losing money on the repossession.
Yes.
Okay, so anyway, to this this is defaults. What these blue bars, right?
Yep. So you see a big spike in default rate, and almost all of that, well, a large proportion of that 9.3% default rate that you see spiking to are situations where you're underwater. So if we think about our previous $4 trillion commitment from our friends at Fannie Mae, that means that their liability is, like 8% of 4 trillion. So that's a big liability created all at once.
Wow.
Which brings us back to our previous slide and the concept that becomes famous during the crisis of wrong way risk. So one of the key elements in risk management in the financial markets generally is the idea that owning a lot of different products diversifies your risk and puts you in a situation where you're protected to some degree. So one of the key principles that a lot of the people in the mortgage markets were looking to in order to justify the size of their inventories, the size of their guarantees, was this idea that you had a lot of uncorrelated housing markets all over the United States and even globally, and you wouldn't ever have an event where these markets moved in unison. But
right.
in 08, we have a market where all of these markets begin to move in unison, and the concept of wrong way risk is that instead of risks offsetting, risks add. So instead of your risk in the fact that your risk is divided between California, New York, or whatever, mitigating your risk, there's actually no mitigation.
Yeah.
Because
Diversification doesn't help you.
Yes.
You're just diversifying into a lot of crap, basically.
And you have this problem for the agencies, Fannie Mae, etc. But you also have this problem at the level of the credit default swap market, where the writers of credit default swaps theoretically are diversified because they're insuring lots of different assets, but they're insuring lots of different assets that are all correlated to the same broad trend in the real estate market. So we talked a little bit about the origin of the decline in real estate. Then we talked about the origin, the difficulties that Fannie Mae was going to have in meeting its commitments. The next level down is, okay, well, if you as a broker dealer can't look to Fannie Mae, then you're looking to the credit default swap issuer to look for them to come up with the shortfall, and you have a bunch of credit default swap issuers that are also organized with wrong way risk against in the asset-backed lending market.
Okay, ready for the next slide?
Yeah, so that's kind of the overview of that's the introduction to the landscape as it was setting up going into the crash.
Right.
We're going to introduce some characters here that we're going to review. First, just to get a sense of the scale and diversity of the institutions here that go down in rapid succession. I pulled a list of key, mostly American institutions that go down in the 08 crisis, ordered by date.
Okay, so the reason why this is focusing on acquisition is because these are companies that got acquired as opposed to being liquidated, basically, right?
Well, yeah. So they're all liquidated in a sense. So every one of these institutions is acquired in an emergency deal.
Right.
So when we get to lecture 3 about the bailout, we'll note that there's kind of 3 mechanisms that are used. First, there's TARP that's targeted at the markets themselves. Then there's the explicit bailouts that are more targeted at, for some reason, like the auto companies and GE and companies that have no business being related to the financial crisis itself. And then you have the third mechanism, which is used most in the financial markets, and that's forced marriage. So you have a bunch of banks or broker dealers that collapse in asset value very, very rapidly, and then a set of key actors arrange their acquisition.
All right.
When you say forced marriage, you don't mean the government forces it, do you?
So I mean that there was a set of actors at the Fed, the New York Fed, and the SEC that compelled, in order to maintain access to, so they had in their hands the weapon of the TARP funds to compel action from actors in the financial markets. So if we look at Bear Stearns as an example, when Bear Stearns went under, and it went under very, very suddenly, JP Morgan was in the position of drawing funds from TARP, which gave unique leverage to the state to compel them to purchase a set of assets.
Mm-hmm. Got it.
So they dangle a carrot out in front of them and tell them, you better do this.
Well, they've put the carrot in their back pocket. The institution has come to depend on it. And
I see.
I mean, wow.
Less of a carrot, more cocaine.
Yeah, less carrot, more cocaine is probably a good descriptor.
Yeah, okay.
Okay,
I see
so
now.
so I'm just I it's been years, so I didn't remember. I mean, Bear Stearns. Wait, Fannie Mae and Freddie Mac were acquired?
Yeah, so they go under completely,
wow.
and they're acquired into the federal government.
Oh, okay, right. Wow. Okay, so yeah, the whole privatization of Fannie Mae and Freddie Mac is basically reversed as a result of this crisis.
They unprivatize it. They give the shareholders nothing, and assume.
Yeah, it's the typical nationalization where the government steps in and has no care for what was going on beforehand.
Well,
but yeah, so
what was happening beforehand was any really good.
Well, I mean, if
Just
you're giving the shareholders nothing.
That's
just
true.
highlighting names on this list that jump out to me, just familiar to me. Bear Stearns, Fannie Mae and Freddie Mac, Merrill Lynch. I forgot about that. Lehman Brothers is on there twice for some reason. Yeah. And then the Lloyds. That isn't like Lloyds of London, the famous insurer, is it?
That is Lloyds of London, the famous
insurer. Oh my goodness, Lloyds of London. Jeez, this was really an earthquake in the industry, right?
And not just in the industry, but think about the dynamic at play here, where you have state actors suddenly deciding who is going to own and run these massive books of business that have been established for, in many cases, like 100 years. So you suddenly put power, like almost unequaled power, into the hands of the agencies trying to arrange the new normal after this earthquake.
Wow. Okay, anything else to call out on this slide, sir?
So I think, so I pulled here a list of, 15 institutions. If you go on Wikipedia, you can find there's like 200 of them they pulled out. There's actually thousands of regional banks that go under, and the existence of regional banking has been for a very long time a unique, diverse feature of the U.S. economy that is severely reduced as a consequence of the financial crisis. So as of today, regional banking plays a much smaller role in the U.S. financial system than it did prior to the crisis.
Right. So it's relatively more consolidated in the banking industry as a result of all this.
That's correct. And the banking industry itself becomes, ironically, much more consolidated on Wall Street, whereas before a lot of these institutions were located elsewhere, just from the point of view of the politics of the industry. A lot of the firms that go under are the firms that have key players elsewhere.
Or to use a quick movie reference, Mr. Potter finally gets that savings and loan.
That's right.
Okay, we are not focusing on the values here, but they're really big numbers.
They're in scientific notation.
Yeah, I'm not used to seeing that. What are those? 10 to the 10 and 10 to the 9? Anyway.
So you'll notice the largest one by far is Fannie Mae. It's the only one that's 10 to the 13.
Fannie Mae.
So
Only a small event then.
Yeah.
No, it says 2 times 10 to the 11th.
Sorry, 11 there? Okay. Sorry,
Yeah.
right.
There's
My eyes
9s
are
and
failing.
10s, and that's the one that's to the 11th.
There
Yeah.
we go. My eyes are failing me here. Okay, fine.
Yeah. Okay, shall we continue then?
Yeah, so we're going to wrap up with a quick rundown of the characters here. Some villains, some heroes. These are selected as archetypal characters in the crisis. So, I could have pulled out the financial crisis is a complicated event. It has hundreds of actors that are really significant, but we pulled out some archetypes here. So let's pull them out here.
Okay, so this is Bernanke. Remind us now, when is Bernanke's term? Do you know? Or can someone
So
pull it up?
Ben Bernanke's term begins in 2006 and ends in 2014.
And
so
he picks it up from
entirety
he
of the crisis-
immediately follows Greenspan.
Yes, he immediately follows Greenspan.
Okay. So to
and
be
he
fair to
goes on
him,
until we have Yellen.
to be fair to him, he's inheriting this basically. I mean, I'm assuming by the time he becomes head of the Fed, the stage is pretty much set for this crisis.
Yeah,
Right.
well, if we remember our chart on subprime originations,
Yeah.
the big discontinuity is in 2004. So
A couple
we're
of years
already-
before he's there. Yeah.
Yes, we're already
if I can
well
be-
into the malinvestment cycle at this point when he becomes chair. And what he's responsible for is really the restructuring of the economy and the reimagining of the role of the Fed.
Right.
If I can be less charitable to him, if I understood everything correctly when I was reading about him, he also just kind of went right along with the crash and tried to say this is fine, everything is fine, this won't blow up, leading up into the crash. So like he did his fair share of playing cover for Greenspan, if I'm not mistaken.
Well, I think that's a not entirely fair characterization of what was going on. So one of the really interesting things that happens is in 07 all the way through till the fall of Lehman in 08, the Federal Reserve and other financial authorities take the position that this is a typical malinvestment cycle and fail to appreciate the way in which financial institutions are linked together through this network of through the repo market and through the CDS network. And so they're expecting that this decline in real estate prices will cause mortgage defaults. It'll cause, maybe some isolated institutions to go under, like went under in the savings and loan crisis. But they don't understand the phenomena of contagion. And you have this period of maybe 6 months between the fall. I could look at my chart here and find out exactly how long it was. But there's this period between the fall of Bear Stearns and the fall of Lehman, where people inside the industry, between sort of April of 08 and the fall of 08 when Lehman falls, September of 08, when people in the industry almost universally appreciate that the entire industry is in peril, and the regulators seem to be completely unaware of this fact. And so a lot of the criticism that Bernanke gets and a lot of his peers get is related to this period between sort of early 08, when it starts to become obvious in the industry that there's a really big problem, that it's an industry-wide problem, rather than a problem at the firms that are specifically involved in mortgage origination. And eventually, the regulators and the Fed start to appreciate the scale of the problem and take unprecedented action to try to deal with it.
All right.
To be fair to Bernanke, the wisdom of the time, although this was not universal, and notably the Austrian school was one of the lone voices to say that there was a bubble here. The wisdom of the time, even up to late 2007, was that the housing market was solid.
Well, not only that the housing market was solid, but one of the things about the Federal Reserve and economists generally is that they, for the most part, didn't come up the track of the securities market. So they had no background in the way in which financial institutions were linked together to foster contagion.
Right. And then on Merck's point about the housing bubble in 2004, there was that famous report from the Fed that said that there just was no bubble at all, and which caused it set their policy for the next few years, if I remember correctly, from what I read.
Yeah. So I mean, it's fair to lay blame on the Fed for the bubble, the way that they're responsible for, the savings, the way that they've been responsible for other bubbles previously. But there's the unique character of the 2008 crisis does not appear to have been an intentional manufacturing of the policy of either Greenspan or Bernanke.
Right,
Okay.
because we Austrians emphasize that the central bank plays a big role. Having said that, the central bank did not pass the Community Reinvestment Act, et cetera, right? There's a whole lot of stuff you've explained to us today that didn't come from the Fed, right?
That's correct.
Yeah.
So our next wonderful character here is Hank Paulson. He's the Treasury Secretary under Bush and the architect of the first federal response to the financial crisis, which was called TARP. TARP stands for Troubled Asset Relief Program. And what TARP was, so when it became clear to the Treasury that the decline in price of mortgage-backed securities, the mimetic decline in price of mortgage-backed securities, was a problem for the financial markets broadly, Paulson and the Treasury Department came to the very obvious conclusion: why don't we just buy some? And they assembled a $700 billion relief program whose job it was to buy these distressed assets. And we'll talk about TARP and its impact as we go through the mechanics of the crisis 2 weeks from now. But that fund is actually a very successful fund, just on a straight economics point of view, because they buy distressed assets in a mimetic crisis and they end up selling them later at a higher price.
So the story I'm used to with these crises, Black Horse, is that it's an opportunity for them to shove something down our throats they had been preparing, right? I'm thinking like the Patriot Act in 9/11, for example, right? Or the invasion of Iraq in 9/11. These are things they've been working on for years, and they just, oh, here we go, here's a chance. Tell me if I'm wrong. I kind of get the feeling in this case, it's more like, what do we do? Let's make something up.
Yeah.
Mm-hmm.
So certainly TARP is the let's make something up answer. Mm-hmm. So we got this problem in the mortgage-backed market. We don't know what to do about it. What if we just spend $700 billion buying mortgage-backed securities? Maybe that'll make the price go up.
Right.
Light isn't going up. Light isn't going up.
So that's Hank Paulson's initial contribution. Paulson becomes significant later on because the fact that the Fed is the prime buyer for these mortgage-backed securities that are in distress becomes a really, really powerful lever during the course of this crisis to make firms do whatever they want. Right. So we talked about forced marriages as a mechanic here. Well, if you're suddenly put in the position where without the Treasury Department buying assets from you, you're out of business. They have a lot of leverage in negotiating with you to make you do whatever it is that they think you should do.
Got it. Yeah, so this is part of the Fed getting into a stronger position, stronger, I don't know, central planning position, you could say,
Well,
than they had
remember
been
this
previously.
Treasury Department is part of the executive branch rather
Right.
than the Fed.
Right. He's just directing. He is directing like very direct government influence rather than the Fed, which is usually more, in comparison, hands off.
The Fed has a different. The Fed has different actions to lay at its feet, but it's
Right.
important to realize that this is like direct executive action rather than.
Okay, I think you misspoke and I got confused. The 800 billion, whatever, that was not the Fed. The Treasury bought those
That's the
mortgage-backed
Treasury,
securities.
yes.
Okay, got it. Okay, I think you said the Fed accidentally. All right, so the Treasury buys that and later sells them at a profit. But in the meantime, you're saying its purchase of those things gives it leverage to kind of decide what's going to happen with various big companies and stuff.
That's right. And partway through this event, our friend Mr. Paulson gets replaced by the Obama appointee, Mr. Geithner, who is suddenly handed.
It's not a name you usually hear.
I'm sorry, is this the next slide? Is this the next slide? I don't know what he looks like.
Yes.
Okay.
Yeah,
This
the
is
next slide.
Okay, got it.
So he's less famous than Mr. Bernanke, but he is the architect of a very large number. Mr. Paulson and Mr. Geithner are two of the most influential people in the reorganization of the seats of influence in the financial system. So all those firms that you saw change hands, Geithner and Paulson are deeply involved in making all of that happen.
Right.
Wow.
Geithner also architects a program called the liquidity stress test that compelled banking firms to go through a Treasury-directed stress test before they were eligible to do things like issue dividends, buy back shares, issue executive pay beyond certain limits, essentially come out of loose control from the Treasury Department. And for reference here, I don't think Citigroup actually passes the stress test until like 2012. So the Treasury Department assumes effective control of a number of these firms for 4 or 5 years as a consequence of the stress test.
Paulson tried to at least work with the market, which is crazy as that sounds to us, with the TARP and a few other things, if I remember correctly. Geithner instead just says, well, we'll just assume control and regulate them until they come out of this.
Yeah, so Geithner is the architect of nationalize them until we can let them go kind of strategy.
Okay.
Whereas Paulson is the comparably free market advocate in the sort of dialectic that we're working in.
Right, but in both cases, it's fair to say that they were not just letting the market sort itself out.
No, neither of these are non-interventionist characters.
Yeah, they're trying to centrally. They're trying to centrally plan the bust, basically.
But well, to be very clear here, Geithner effectively nationalized most of these.
To the point where the Treasury Department was putting people on boards.
Right.
Right.
So the Obama administration directly or indirectly, I guess, if they were putting people on boards instead of themselves, controlling, financial institutions and then auto industry as well, right?
Yeah, the auto industry, GE, all these other firms that go down at the same time, the Treasury Department uses similar levels to go after. When we talked about the asset-backed security and the financialization of everything, one of the consequences of that is that these same tools were applied not just to banks, though that's the piece of the industry I'm most familiar with. They were applied to all of these other firms that had financialized themselves into trouble.
All right. So, and that's a lot. Like, were there any parts that weren't really impacted by this?
Well, I mean, anybody who wasn't in the lending business, right?
Okay,
So,
but like we've already covered, if it's banks and auto industries and like, you know, a few
banks,
other
auto industry, commercial, anybody, credit card industry, and like consumer finance, that's a lot of the economy.
Yeah. Okay.
Just that. Okay. Next figure. Who's
Next
this?
figure here. So we have Richard Fuld. Fuld. I don't know how to pronounce his last name. He is the official scapegoat for the financial crisis. He was the CEO of Lehman Brothers for like 12 years. The last CEO of Lehman Brothers. He's the guy who Time Magazine called the architect of the financial crisis. He tilted Lehman Brothers. So he's kind of the archetype of the CEO that did not understand the crisis very well and tilted his business toward the assets that would. So over the 12 years he was there, he tilted Lehman Brothers towards participation in the MBS space, and he was late to recognize the liquidity problems that Lehman Brothers had and seek additional capital, so that by the time he went to seek additional capital, the options available to him were extremely limited.
Mm-hmm.
So if you contrast that with the executive team at Citigroup that went and sought additional capital several times before they eventually had to go to the U.S. government. So like they famously sought additional capital from the Crown Prince of Saudi Arabia during the first part of 08 and were able to temporarily bail themselves out until the U.S. government bailed them out again later. Fuld is criticized because he famously rejected a few offers for purchase of Lehman Brothers prior to the collapse of the stock price.
Yeah, but why did? Okay, it sounds like you don't totally buy the story that it's his fault. But where's the plausibility? Why would they feel like they could tell that story? Is it because the timing of Lehman Brothers
it's because
collapsing?
Lehman Brothers is the moment at which it becomes officially acknowledged that the financial crisis is a thing. So if we go back to our timeline of intervention, there's this period between Bear Stearns going under, which is the first casualty of the mortgage-backed security market, and Lehman is kind of the next really big domino to fall in the fall of 08. And the fall of Lehman Brothers is what precipitates TARP and the action at the Fed. Basically, all of the elements of the apparatus swing into action in the fall of 08 in response to Washington Mutual, AIG, and Lehman Brothers going down in rapid succession. Lehman is the biggest of those bankruptcies, and so he gets the blame.
Got it.
So
Okay.
prominency and sensationalization.
Well, and he also gets the blame because he turned down capital in the summer of 08. So in the summer of 08, I think it was JP Morgan that was trying to buy them, and he famously went on TV and talked about the sufficiency of capital in Lehman Brothers, and then like 2 months later, the thing was bankrupt.
Right. Okay, I remember that interview.
Yeah. Well. Surely, but I get people see it that it's his fault, but is it really just they were angry at him for not selling? I mean, it doesn't even on a surface level analysis, it doesn't really hold up.
Well, the issue here is you might be able to blame Fuld for Lehman Brothers' individual failure, but it's not reasonable to blame him for the broad
catastrophe,
right?
Right. He
So
didn't introduce these. He didn't introduce the systematically screwed up incentives, etc.
That's right. He just mismanaged his own firm.
Right. Okay, next slide.
So Jamie Dimon here is an example of a CEO who did not mismanage his firm through the crisis. So JP Morgan comes through the crisis. They've got loan write-downs, but they've got sufficient capital to deal with it. Famously, Dimon claims that he was compelled to take loans by the federal government. So he claims, and this claim is disputed by Mr. Geithner, he claims that the Treasury compelled his firm to take TARP. And
basically, he didn't. He's saying they didn't really need to. They were in good enough shape. They could have avoided that.
That's correct.
Okay.
And so, like, he's an example. He and JP Morgan are an example of a firm that has sufficient capital, navigates through the crisis, and he personally takes a lot of. I mean, he's subpoenaed before Congress a whole pile of times over this. He becomes an enemy of the cathedral as a consequence of this. But he holds on to his position because they're able to get TARP out the door and get the Treasury Department out of their hair in sort of rapid succession, compared to an organization like Citigroup where the Treasury stays involved for like 5 years.
So when you say it becomes an enemy of the cathedral, could you go into more detail of that?
Yeah, so during 2008, there were all kinds of articles written about the fact that during key moments in the financial crisis, he's off sailing and refuses to take interviews. And so, like, the Wall Street Journal and CNBC are unhappy with him in these moments. He's brought before Congress in a very famous hearing where he's asked to justify why JP Morgan makes profit. This happens to Goldman Sachs a little bit more aggressively than JP Morgan.
Continue that thought. He was justifying what?
So they make profits on their hedge positions that are designed to protect them against the advent of So on their balance sheet, they've got mortgage-backed securities. They have securities that are designed to hedge against losses on those mortgage-backed securities on which they make profits. And what the congressional hearing does is it singles out the profits that they make on these short sells and short on these positions that are either short or derivative positions. And they try to argue that JP Morgan and especially Goldman Sachs were profiteers during the financial crisis.
Right.
In a hearing that
taking prudent action is profiteering.
Yeah,
that's correct.
Money industry functioning as it should have.
I think the hearing he has in 2010, it's like a 6-hour testimony or something absurd like that.
Jeez.
So, I mean, he's not an enemy of the cathedral at the level of, Mr. Trump, but certainly he gets pulled through the ringer a little bit. And he gets pulled through the ringer in a way that I feel a lot of sympathy for, because he's pulled through the ringer explicitly because he responsibly manages his firm through this period.
So you said earlier that Geithner disputes that the Treasury Department forced him or coerced him or pressured him into taking government aid.
Yeah, this is an argument. He didn't say anything at the time, and then like 2012 onwards, he starts to make this claim that he was compelled to take TARP money. You can, I'll let the audience decide for themselves who they believe.
All right. So there's nothing more. It's just he said, the other guy says.
Yeah, I mean, you could pull apart their financial statements and try to make an assessment. I think the balance of evidence is in Dimon's favor.
Right. Yeah.
Pretty strongly, but one of the issues during this period is you have rapid evolution of the price of mortgage-backed securities. So it's very difficult from the outside to make it an analysis based on quarterly financial statements.
Okay.
Okay, ready for the next character? Okay. JP Morgan Chase. Wait,
we have an extra picture here. Who do we have an extra picture of?
The one we're on now?
Yeah, so this guy here, JP Morgan and Chase, that's Jamie Dimon. We haven't. Okay. Sorry, I got them in the wrong order. I missed Lloyd Blankfein, who's very much a similar figure to Dimon, but instead of JP Morgan, he works for Goldman Sachs.
So slide 19 is JP Morgan. I should
Slide
slide
19
18.
is Goldman Sachs. Sorry, you're right. Slide 19 is JP Morgan. Slide 18 is Blankfein.
Okay, I was showing
Okay.
the wrong person as we talked about Diamond. Anyway, go ahead and talk about.
Okay.
So
Anyways,
who's this now?
Blankfein is a similar kind of character to Dimon. He gets in a lot of trouble because Goldman Sachs makes a lot of money trading the mortgage-backed security market. At the same time, the Treasury is intervening to try to save the rest of the industry. And that's a consequence of Goldman Sachs' kind of unique model as a true investment bank instead of as an institution facing retail.
Okay.
Okay, so move on from the two of them then.
Yes, to Kathleen Corbet.
Got it.
I like the note that you had in the notes for this one.
Yeah. So we talked about two legitimization mechanisms that existed for mortgage-backed securities in the period leading up to 08. One of those mechanisms was the explicit guarantees by organizations like Fannie Mae. Another one of those mechanisms was the ratings agencies. So Kathleen was the CEO, the president of S&P at the time. She became famous when she was drawn into a massive conflict of interest case where there were allegations that S&P and other rating agencies were inappropriately paid in order to rate AAA these mortgage-backed securities. There's a settlement that comes out of this. The fine that they get is from the regulators is $1.5 billion. My personal favorite part of this story is that she somehow has a real job in the industry still as a consultant.
Somehow.
So she got her firm fined $1.5 billion, and she now runs a consulting agency, and people hire her to tell them what they should do with their business.
Amazing.
I don't get it.
One of
It's
the
a
great
big-
all
it's a big-
time,
it's
one
a
of the
big-
all-time
it's a big
great
club and we're
fail
not in it.
alpha moments.
Yeah. Right.
So there's the sort of high level introduction. The last slide here, my personal favorite character, the FOSC, Financial Stability Oversight Council, which was established by the Dodd-Frank Act. That is the typical federal response to this crisis, which happens 2 years after the financial crisis in 2010. So
Right.
Not unlike the Build Back Better Act in 2022, 2 years later, we have an act designed to reform the financial system and make sure that all these bad things that happen never happen again.
And
Right.
I see some of the same players in the signing of the FSOC I see some of them signing this into law that are in the government still today doing the same thing.
Yes, and you'll note that two of the key architects of this piece of legislation are Hank Paulson and Tim Geithner, two of the sort of key elements of the government that oversaw this reorganization. And so we'll see, particularly in Lecture 3, how the financial system as we know it is constructed, but the FOSC is a new institution that is architected explicitly to control the actors that we saw, throughout this lecture.
FSOC. Black Horse. You keep
Yes.
saying FOSC. FSOC.
Yes, I apologize.
I would just like to point out as well in the show notes for this one, it was just one word after the linking to what the FSOC was, and it was just cursed. I can't wait to get into this in Lecture 3. Lecture 3 is going to be really fun.
In fact, could you, Black Horse, real quick, before we go to respond to a few chats, very small number, could you just give us a quick, one sentence on the second part and the third part so people know what's coming?
Yeah, so part two, we're looking at the mimetic failures of institutions during the crisis. So the factor which most distinguishes the financial crisis from other malinvestment cycles is the way in which the financial system was interlinked through both the rehypothecation market, the CDS market, and the derivatives market more broadly, that causes these mimetic crash events and causes them to happen virtually overnight. So we talked a little bit about Lehman and how quickly it failed. That within a couple of months of saying everything was fine, the firm was out of business almost immediately. A similar thing happens at Fannie Mae, where famously 2 days before Fannie Mae gets nationalized, the management of Fannie Mae goes on TV and talks about how they have no capital insufficiency problem. And then 2 days later, they're nationalized because they have insufficient capital.
Oh, and better yet, though, they say they have been told they have no problem. So nothing comes of that, because that was technically correct. They were told they had no problem, and they go back after like everything hits the fan. They're like, oh, we actually did further investigation and found out the issues.
Yeah, well,
that's what made that one so
infamous. This one is particularly bitter for me because I lost money on call options on them. So,
Okay. So you're saying that, I think what you're saying is in part two, we're going to understand a little better how it is that these institutions who presumably know their business or think they know their business could have this confidence, and then months, or in this case, days later, it collapses all
just
around
evaporate, them. Yes.
Yeah, we're going to be able to get a handle on that a little better next time, right?
That's correct. That's the focus of lecture 2, is discussing a series of these failures and how they occur and why they occur so suddenly and in a way that's so shocking to the people sort of involved.
Wow. Amazing. But I think the lesson we can draw from this really is that we should just trust the experts and do what they tell us to do, right?
And then lecture 3.
And then lecture 3, we'll talk about the federal response and the lasting legacy of 08. So what we've talked about to this point has been very American-centric, but it's worth noting that there are that in terms of decline in economic output, the crisis is actually even worse in Europe than it is in the United States, and more lasting there. And there's a whole number of reasons for the way in which different economies sort of come out of this, because there's, as we've discussed here, there's a massive reorganization in both the specific players in business, but also in the structures and incentives that kind of exist afterwards.
Okay, well, you've anticipated one of our super chats. Zoop, a great supporter of the show, says, this stream hits closer to home as it was the only financial crisis I was old enough to perceive. Will you also cover the fallout in Europe later on? Thank you for this. And basically you're saying in the third part of this series, you're going to widen the focus outside of the US.
Yeah, so in the third part of the series, we'll look at that.
And that's where I get to work on my original hypothesis that nationalizing all these industries would cause them to drift leftward, especially looking at the administration that did so.
Yeah, well, I mean, it's worth contextualizing my own expertise at this juncture. I have very deep expertise in the markets aspect of the North American crisis. I'm a primary source in that regard. I'm not. I don't have the same kind of depth of primary knowledge as to what was going on in Europe. So that'll be.
Got it.
That's my own bias rather than a reflection of the reality.
Right, but you're bringing context and knowledge that'll help us understand Europe as well, I'm betting.
Right.
Okay, so a tip on Subscribestar from Stam153, a faithful Subscribestar tipper. He says 2008 title, The Year the Line Didn't Go Up. Very good. And then we have one more. I read Zoop's out, but one more from Super Chats. Stray F says, somehow the hardest history to remember is the stuff I lived through. Looking forward to rewatching this later. Shout outs to Lambda's Bible studies. Yes, friend of the show, Luke Lambda. Doing great work there. Okay, I think I caught everybody. Let me make sure somebody didn't slip something in at the last moment there. Oh, actually, there was a non-paid for chat that I am going to deign to notice because I thought it was a good question. Give me just a sec to find it. I know who did it. Somebody said, did they mean to do this? Oh, come on, I can't find it. Oh, I don't know where
Is it
went.
the one that was, so did the cathedral plan the collapse to get control, or?
Yeah, it's gone. He
Oh, okay, I have it right
retracted
here. I have it right
Why
here.
did he
I
do
have it here
that?
too.
Harold Bredsdorf. So did the cathedral plan the collapse to get control, or did they exploit an unexpected collapse?
That's a great question. I am not a member of the cathedral to comment on it.
You're not a primary. You're not that kind of primary source, Black Horse.
With
You're not
the
a. You're not a
analysis that
double.
you can
You're not a double agent to the cathedral.
Well, let's put it this way: if I had an early life section by Wikipedia, it would be interesting, but it wouldn't be that interesting.
Okay.
Sounds like
It
something a
was
double
one day
agent
with the
would say.
music.
If you look at how the U.S. government typically operates, especially throughout the end of World War II up until the end of the Cold War, very rarely inside the U.S. do they start something. They will jump onto something and ignite it and throw gasoline onto the fire, but usually they don't like get in a boardroom together and say, oh, let's go start the civil rights movement.
Well,
they'll jump onto something.
I mean, the basic question here is: did the architects of the Community Reinvestment Act and Fannie Mae understand what the consequences of those actions would be? And the
I'd be willing to bet no.
Yeah, the answer to that question is I would somehow doubt that. I somehow doubt that there are people out there with 40 years of foresight on that.
Right.
But in a sense, the financial crisis is predictable from that moment, right?
Well,
right.
Jimmy Carter's still around. We can go ask him.
Yeah, right. But this is a theme I've been harping on, Black Horse, and tell me if you have a different perspective. Sometimes I get concerned that people get a little too 4D chess with our overlords. You know, I mean, absolutely agreed that conspiracies against the public interest are real. I mean, that's just normal business from my point of view. Big government, big business working together to screw the rest of us. That's just absolutely sane, normal, healthy view of life to see things that way. But the idea that like everything that happens, oh yeah, they foresaw this and it's so they could do this. Sure, opportunistically, as Ryan pointed out, something happens, they didn't expect it, but they're like, well, maybe I can shove this through in the panic, right? Opportunistically, they'll take advantage of a crisis, but to think that it all is some big plan basically means that you believe that central planning is real, right?
Well, I also think that the fact that there's a 3-year lag between the decline in real estate prices and Dodd-Frank appearing suggests that there wasn't this piece of legislation, wasn't waiting in the wings.
Right. Because with the Patriot Act, we saw the other case, right? Where 9/11 happens, and then suddenly there's this like 5,000-page piece of legislation that's just boom. Hey, vote on this, guys. This is what we need to do. And it's like, whoa, where did that come from?
Radlib, don't you have the typing speed to write like 6 pages a minute?
Yeah, right.
You can do that, right?
Yeah, I mean, the Patriot Act, it's a great contrast, right? It's very obvious looking back at the Patriot Act that many of the things that were done in the Patriot Act, whatever you think of the precipitation for it, were things that various players had wanted to do for a long time. It's very non-obvious. If there is, I mean, look, there are elements that were obviously planned some regard in the bailout packages. So, for example, the repeal of a liquor tax in Puerto Rico was an element of the financial rescue plan. So it's very obvious that this is like something that somebody had sitting in the wings and used this as an opportunity to exploit. I highly doubt that whoever that was caused the financial crisis in order to get a liquor tax repeal. Like, that doesn't seem plausible to me.
Mm-hmm. Right.
Hmm.
Yeah, opportunistic versus, they're masters of the universe who foresee all, and they did this thing 50 years ago, which they knew would lead to this other thing that their grandson would take advantage of or something. It starts to get something where I have trouble believing it.
Right.
Well, and look, I'm enough
Yeah.
of a primary source to tell you that the financial crisis genuinely took by surprise most of the elite within the financial system.
Right.
And keep in mind some of the terminology we use as well. We call these people the cathedral because they are inherently decentralized and adaptive and not all-powerful and planning and malicious necessarily.
Mm-hmm. Right. So when you say that the panic was real, you're talking about looking into people's eyes and going, "Oh yeah, they're freaked out," right?
Yeah. Well, I mean, to give you an example of the kind of psychology that was at play, an associate of mine, the day that Lehman went down, got a call from the Fed that the summary of which was, we got an armored truck with like 500 million in small bills. We're going to drive it to the Midtown Manhattan branch of JP Morgan, and CNBC is going to be there in order to film regular financial transactions occurring in order to increase public confidence. And you're going to stack this cash behind the wicket to show that you haven't.
Wow.
Yeah, no,
So
that
this
sounds.
is like
sounds like good
Soviet
propaganda.
Potemkin Village kind of stuff, right? Everything's fine, guys. Look at all the money.
It's interesting
hilarious.
that they felt the need to do because everything, even in 2008, it's just interesting that they felt that they had to visually show the money, because even at that stage, the majority of money was done through online financial transactions where there's no real cash being exchanged; it's numbers. So it's an interesting tool of propaganda that they felt the need to visually show it to the people.
It's amazing. I mean, they really did this.
Sorry.
They really did this NBC broadcast with the guy stacking cash, right?
Yeah, so they did a CNBC broadcast from the branch on like Squawk Box, showing people like normally interacting with JP Morgan.
Yeah.
That's amazing.
Redlib, if you want to check your Discord DMs, I've sent you something that I think it will be quite interesting for this little chat we're having. And Dark Horse, while he's getting that, could you explain to us, was this a moment for you where you started to question the system and come down the path of where you are now, or was this kind of something that you were already on? Because this is even today, most financial traders are not following the Austrian school, or they're not looking at the way that you might be looking at it.
Yeah, I mean, so I was young when this happened. It's an interesting moment in my own life history, kind of a formative one. I would not be in the position that I'm in today were it not for the events that occurred in those 2 years. And there's limits to how much I can talk about that.
Yeah.
From my own point of view, it was certainly in this period when I started to notice what I call the say-do gap between the way that government acts and the way that government tells people that it acts. So, and to me, the essence of what is broadly termed the red pill is the idea that the reality that you're presented with is a carefully constructed series of lies. And certainly the financial crisis is both the crisis itself and the narrative that was constructed during the Obama administration of the crisis made it very obvious to anybody who had their eyes open, who was engaged in the industry, that nothing that you see in media has a direct relationship to reality. That it's something like instructions rather than a description of reality.
Right.
Yeah. Right.
Yeah. What's the name of that effect where you realize that about your own area, but then you turn the page of the newspaper and read what the government's saying about health or something, and you go, "Oh, I'm sure they're right about that, though."
The Gellerman
That's
amnesia
it.
effect. I think
Gellerman
Skeptical
amnesia
Waste is a pretty good
effect.
article up about that. So
Yeah.
go and patronize the channel.
Right. So the trick, of course, is to get from that first realization, hey, they don't tell the truth about my own industry, to the realization, I don't think they tell the truth about anything. Right. Okay. So unfortunately, Mad Merc, I don't know if you could do it because now I'm showing my screen, so I can't. If you could share that into the with the other two, because well, actually, if you pull up YouTube, guys, you'll see it. It's composition of U.S.
no,
mortgages
I won't
by
be able to.
risk.
This is the only tab I'm running because this is the only tab my computer can handle at one
I
time.
can see it.
You can see it. Yeah. So it's showing the risky is the lighter gray portion. And it shows it in 2001, a reasonable chunk of it. 2006, the risky portion of U.S. mortgages looks like it's about half of it. Is that
Half.
Yeah.
46%.
it's half of it, 46%. Yikes. That's amazing. And then in 2008 again, I guess that stuff is, well, I don't know where it's gone. It's been bought by Treasury or whatever. And it's way reduced even from the 2001 level. Yeah, any comments on this? The source on this?
A lot of defaults.
A lot of defaults,
Well,
yeah. Source on this is
part of
Freddie
this, you have
Mac
to
data.
realize 700 billion has evaporated into TARP. So of that, of that 2 trillion in mortgages, 700 billion of it has evaporated into TARP.
Yeah. So any other comments on what the story this chart tells, real quick?
Well, I was just bringing it up because it basically shows the amount of bad loans that were in the system at this time due to government action.
Yep. Yeah, it's excellent. Yeah. Any comments, Black Horse, on this?
No, it speaks for itself.
Yeah. It's insane. Yeah. Okay. Anyway, maybe you'll cover this, but here's the part that freaks me out. Like I was saying to my daughter just yesterday. When I was in elementary school, they said, when you get to junior high, they're not going to put up with this kind of behavior. It's going to be serious, And they said the same thing in junior high about high school, and high school about college, and in college about the real world. And now here I am out in the real world with the adults that as a child, I just assumed they kind of know what they're doing, And I'm like, they don't know what they're doing.
Yep.
They can be swept up into some mania, and that happens pretty regularly. In fact, I'm thinking, of course, the Iraq War frenzy after 9/11, but then also the bubble-like hype leading up to this crash, but also in the 90s, I lived through that too, right? Just all these people being like, oh, reality, the rules of reality don't hold anymore, and line will go up forever, But anyway, note that this is 2006. This is not 2007, 2008. This is 2006. Presumably, this is Freddie Mac data. I assume it wasn't a state secret. Presumably, you could look at this, right? And go, why is there so much risk?
Not only could you, but people did, right? So very famously, there are particular hedge funds that made vast sums of money correctly calling this.
Oh. What did they, how did they do this briefly?
Through a combination of short selling mortgage-backed securities and being on the right side of credit default swaps.
Wow. So they saw it coming.
Yeah, so the movie The Big Short is based on one of these hedge
Okay.
funds that
Three of
famously
them.
saw this coming. And one of the interesting things that we'll talk about a little bit as we go through this is actually one of the problems with the mortgage-backed security market is that it's a very illiquid market. So it's very difficult to agree on what the price of an asset is. So another problem with your CDS contract is that in the regular stock market, the way you get a price is that the security trades, 1 million shares every day. So you have a very accurate idea of what the market will or won't pay for that security.
We call this high liquidity in the industry, right?
That's correct. But most mortgage-backed securities don't trade in any given trading session and often don't trade for months. So the price that gets printed for those securities, both for stating capital on your own balance sheet and for the purposes of derivatives contracts, is either the last trade price or a modeled price. And anytime that you have a modeled price, you have an opportunity there to be manipulative.
And then the
there
last
are
trade
a
price
number
can
of-
just be what you're saying with such low liquidity. The last trade price can just be stale. Maybe it
That's
was
right.
the right price 5 months ago, but it isn't anymore, right?
Well, yeah, and it would be the typical condition in the bond market for the last trade price to be stale, except on a very short kind of list of bonds.
Right. Okay. I'm going to throw out one more super chat that came in from Anu Ra. When you were a child, did you always feel richer with a handful of coins than with a note of greater value? I did, and I exclaimed to my grandmother at 9 years old, "Only coinage is the real money." Yeah, I know. I kind of tease my little children, for being like that. They're like, "This coin is bigger, so I want it," even though it's not a nominal face value less, right? But there is sort of a simple common sense instinct that isn't totally wrong there, right? The feel here, I'll show them off again. Let me go back to this scene. The feel of some real precious metals in your hand, as I'm holding right now, that's going out to our prize winners shortly, contest winners. It feels like, oh, I'm holding something. Like I have real value here in my hand, So the intuition isn't completely crazy. All right, thank you for that. Okay, well, we're going to wrap it up. Please like and share. I hope you found this interesting and meaty. That's the intention here, is we're trying to do a meaty dive. In fact, if anything, I would say, Black Horse, my sense is this was more the intro, providing context. It's actually in this next one that we'll actually have a sort of a deeper dive, right?
Yeah, the next one will be a sort of a technical markets lecture.
Right, so strap in next time for that. But that'll be 2 weeks from now, hopefully. 1 week from now, we'll hit some current events, which we haven't done in several weeks. Hopefully nothing's happened, so there's not much to talk about. We'll see. Kazakhstan. I heard something about Kazakhstan. Anyway, okay. Thank you so much to Black Horse for preparing this material and sharing his deep knowledge in this area. We look forward to the rest of this series. And thanks to everybody for joining us. And we will see you next week.